While you're stressing over your mortgage, the ultra-rich are leveraging billions in jumbo loans and asset-backed loans to amass empires. They exploit tax loopholes and offshore accounts, transforming debt into a vehicle for unprecedented wealth accumulation and leaving ordinary people behind. Discover how this fuels wealth inequality. So how exactly do the wealthy use debt in a way that helps them get even wealthier? It comes down to something called leverage. Think of it like using a small amount of your own money combined with borrowed money to control a much larger asset. For example, instead of buying a property outright, they might take out a large mortgage. This allows them to control a more expensive property than they could afford otherwise. But it's not just about buying bigger houses. The rich often use debt to invest in things that can grow in value, like real estate, stocks, or even businesses. If the investment does well, the returns can be much greater than the interest they pay on the loan. This difference in returns allows them to accumulate even more wealth. They are taking calculated risk using borrowed capital, where the return potential exceeds the cost of borrowing. This allows for quick expansion of portfolio. Another key difference is how the wealthy manage their debt. They focus on assets that produce income, like rental properties or businesses. This income helps them pay off the debt and still have money left over. Also, they often have access to better interest rates and loan terms because of their high creditworthiness and large net worth. Banks are more willing to lend them money, and at lower rates, because they are seen as less risky borrowers. Tax advantages also play a big role. In many cases, the interest they pay on loans used for investments can be deducted from their taxable income, reducing their overall tax bill. This is a significant advantage that isn't always available to the average person with a mortgage on their home. Wealthy individuals often use sophisticated financial tools and strategies, such as lines of credit and margin loans. These tools give them access to large amounts of capital that they can use to quickly take advantage of investment opportunities. They also diversify their investments across different asset classes, like stocks, bonds, and real estate, to reduce risk. This diversification helps them to protect their wealth, even if one investment doesn't perform well. Another aspect is the use of financial advisors, wealth managers, and tax accountants who can offer specialized guidance. These experts help them optimize their investment strategies, minimize their tax liabilities, and manage their wealth effectively. They leverage these expert advisors to maintain their edge and stay ahead of others. But is it fair? Is it sustainable? How does this contribute to the growing wealth gap? These questions remain unanswered. While we've explored some key strategies, more research is needed to fully understand the complex interplay between debt, wealth, and inequality. We've only scratched the surface of how the wealthy navigate complex financial regulations and utilize specialized financial instruments. If you found this video informative, please like, share, and subscribe to keep watching such amazing videos.